10 years from now, you will look back at this decade and realize something simple. Your financial life either accelerated or it quietly drifted. And the difference rarely comes from dramatic moves. It comes from a handful of structural decisions. In America, turning 40 often becomes a subtle financial checkpoint, not because life suddenly changes, but because the compounding clock becomes visible. At dinner tables, casual conversations start sounding different. Someone mentions they have maxed out their 401k for 12 years. Another person casually talks about the rental property they bought last summer. A third mentions their brokerage account crossing a milestone you did not even know existed. Meanwhile, you sit there quietly doing mental math, trying to remember whether you even have a 401k, and whether the $8,000 sitting inside it actually counts as retirement savings. Moments like that can feel uncomfortable, but they also reveal something useful. The benchmarks themselves are not the point. What matters is what happens next. Because if you're approaching 40 or already there, the goal is not perfection. The goal is structure. And once structure exists, catching up becomes far more realistic than most people assume. So today, we're going to look at what financial progress typically looks like by age 40 in the United States. More importantly, we'll talk about how someone who feels behind can still rebuild momentum quickly. By 40, your financial system should exist. Many people think financial success comes from discipline, but in practice, it comes from systems. A financial system simply means your money moves automatically in the right direction. Savings happen, investments happen, bills get paid, and very little decision-making is required. For many Americans in their 30s, the opposite tends to happen. Money flows randomly. Savings occur when there's extra cash. Investing happens occasionally, and financial progress becomes inconsistent. This is why structure matters more than income. Someone earning $70,000 with a strong system can build wealth faster than someone earning $140,000 without one, because the system compounds. In practical terms, by 40, your financial system usually includes 4 simple pieces. First, automatic retirement contributions. Second, an emergency fund. Third, consistent investment outside retirement accounts. And fourth, controlled spending. None of these require perfect behavior. They require automation. Across the United States, this is where many people struggle. According to a 2023 survey from Bankrate, about 57% of Americans cannot cover a $1,000 emergency expense from savings. That statistic does not mean people are irresponsible. It usually means a system never formed. Income arrived, expenses absorbed it, savings became optional, and optional behaviors rarely compound. If you're behind financially, this is the first correction. Not investment strategies, not side hustles, simply building a system that moves money automatically every month. Because once that system exists, progress becomes predictable. Retirement momentum matters more than total balance. When people think about turning 40, they often focus on one number, retirement savings. And this is where anxiety often appears. You hear benchmarks like 3 times your salary saved by 40. But numbers alone rarely tell the full story. Momentum matters far more. For example, imagine 2 different people. One person has $150,000 saved but stopped contributing 5 years ago. Another person has $50,000 saved but invests aggressively every month. In 20 years, the second person often surpasses the first because compounding rewards consistency. In the United States, retirement savings progress varies widely. Data from the Federal Reserve Survey of Consumer Finances shows the median retirement savings for Americans aged 35 to 44 is about $60,000. That number surprises many people. It is far lower than common financial advice suggests, but it reveals something important.
Large numbers of Americans are still building momentum in their 40s, and momentum can still compound significantly. If someone invests $1,200 per month starting at age 40 and earns a long-term average return of 7%, the math becomes powerful. By age 65, that alone could grow to roughly $800,000. The key insight is simple. Compounding doesn't care when you started. It cares whether you continue. So if your retirement balance feels small today, the real question becomes different. Are contributions happening every month? If the answer becomes yes, the trajectory changes quickly. Lifestyle inflation is the quiet wealth killer. Many people assume financial stagnation comes from large mistakes, but more often it comes from gradual upgrades. In America, income tends to rise through your 30s. Promotions happen, careers stabilize, household earnings increase, but expenses tend to rise alongside them. This pattern is known as lifestyle inflation, and it's surprisingly powerful. You start with a modest apartment. Later, you move into a larger house. Your first car payment becomes a slightly nicer one. Subscriptions quietly multiply. Restaurants become routine. None of these choices feel excessive individually, but collectively they absorb the income growth that should have become investments. A study from Harvard Business School looked at spending patterns across income brackets. Researchers found that when household income rises by 10%, spending typically rises by about 9%. In other words, most of the raise disappears. That behavior creates a hidden ceiling. Income grows, but net worth barely moves. By 40, the difference between two households often comes down to a simple question. Did income growth convert to assets, or did it convert to expenses? Imagine two coworkers receiving the same promotion. One increases their lifestyle immediately. The other keeps expenses stable for 3 years. That second person may end up investing an extra $30,000 or $40,000 during that period, and those early dollars compound the longest. This is why controlling lifestyle inflation becomes one of the most powerful catch-up strategies available. It doesn't require earning more, it requires capturing raises before expenses absorb them.
Debt structure matters more than debt size. Debt often creates emotional stress, but the type of debt matters more than the number itself. Across the United States, most households carry some form of debt by their late 30s. Mortgages, student loans, car payments, credit cards. These are not equal. Mortgages usually build long-term equity. Student loans may support income growth. But high-interest consumer debt behaves differently. It quietly blocks financial progress. Credit card interest rates in America now average around 20%. At that rate, money compounds against you. Consider a simple example. If someone carries a $12,000 balance on a card with 20% interest and only makes minimum payments, it can take more than a decade to eliminate. During that time, thousands of dollars vanish into interest, and those dollars never reach investments. This is why many financial planners focus on debt structure rather than pure debt totals. If someone approaching 40 eliminates high-interest balances, the improvement can be dramatic. The freed cash flow often becomes investment fuel. Even a $400 monthly payment redirected into an index fund can create substantial wealth over 20 years. Debt reduction is not always glamorous, but mathematically, it often produces one of the fastest financial turnarounds available. Career income still matters more than investment returns. Many people focus heavily on investing, which makes sense. Markets receive enormous attention. But by 40, one factor still dominates financial outcomes: career income. For most Americans, their primary income source will generate far more wealth than investment selection. A simple example illustrates this. Imagine two people with identical investment returns. One earns $70,000 per year, the other earns $120,000. If the second person invests just 10% of income, they contribute $12,000 annually. The first contributes $7,000. Over 20 years, that difference alone can exceed $200,000 in additional investments before compounding even begins. This is why many financial advisors emphasize career development during the 30s and 40s, not as a motivational slogan, but as a mathematical reality. Higher income expands investment capacity. Across America, mid-career income adjustments often happen later than people expect. Someone who improves their salary at 42 can still dramatically alter retirement outcomes. That improvement might come from a promotion, a specialization, a credential, or switching employers. These shifts are common in the American labor market, and their impact compounds just like investments. So if someone feels financially behind, focusing only on budgets can miss the larger lever. Income growth remains one of the most powerful accelerators available.
The real catch-up strategy: financial friction reduction. If someone reaches 40 feeling behind, the instinct is often to panic. Aggressive investments, risky strategies, trying to make up time. But the most reliable catch-up strategy is far less dramatic: reduce friction. Financial friction simply means the small behaviors that constantly drain money. Subscription creep, impulse purchases, unplanned upgrades, unmonitored spending. Each one feels minor, but together they quietly redirect thousands of dollars every year. Across American households, this pattern is common. A report from C+R Research found that the average American spends about $219 per month on subscriptions. Many people estimate far less. That gap reveals how unnoticed spending accumulates. Now imagine redirecting that $219 monthly into investments instead. Over 25 years at a 7% return, it could grow to around $175,000. That example is not extreme. It simply shows what happens when friction disappears. Catch-up strategies rarely come from dramatic sacrifices. They come from reclaiming money that was quietly leaking away. And once those leaks close, financial momentum becomes surprisingly fast. Turning 40 does not mean your financial story is written. It means the structure becomes visible. By that point, most stable financial lives include a few consistent elements: a working financial system, retirement contributions gaining momentum, lifestyle inflation under control, debt structured intelligently, and income still evolving. Across the United States, many people reach this stage feeling behind, but the data tells a calmer story. The median retirement savings for Americans in their late 30s and early 40s remains relatively modest, which means progress is still unfolding for millions of households. Financial progress rarely comes from one dramatic decision. It comes from systems that quietly repeat, month after month, year after year. So if you find yourself sitting at that hypothetical dinner table one day, listening to someone casually mention their investments and feeling that familiar moment of financial self-doubt, remember this: the benchmark conversation is not the real turning point. The real turning point is the decision that happens afterward. And that decision, unlike the past, is always within your control. If you found this breakdown useful, consider subscribing for more clear explanations about how money actually works. Thanks for watching.